G'day guys, welcome back to the Devon Too Good investing channel. In this video today, we're going to be doing a deep stock analysis and stock valuation for Hingham Institute for Savings. This is a small regional bank located in Massachusetts in the United States. And from what I've seen so far, it looks extremely attractive. So let's talk about what we're going to be going over in this video. So first of all, we're going to be doing a business overview of Hingham's. We're going to be looking at key fundamental metrics such as the net interest margin, the net charge-off ratio, deposits and funding sources, the efficiency ratio, and the amount of leverage Hingham's has. These are key fundamental metrics when valuing or analyzing any bank. So not only can you use this for Hingham's, you can use these same metrics for any other banking business. So we're also going to be doing a deep dive into management, which includes looking at their insider ownership, their compensation, their return on equity, and their return on assets. And then finally, we're going to cap this video off with a valuation just to see what we should be paying for Hingham's in order to get an adequate return on our money. So if we get into the business overview now, so as mentioned, Hingham's is a regional bank located in Massachusetts in the United States. They have a market cap of $633 million, and it's a probable small cap compounder for these reasons. So they have high amounts of retained earnings. So when the company makes money, most banks give their earnings back to shareholders via dividends and share buybacks. However, Hingham's tends not to do this. They tend to reinvest that money back into their own business in order to compound over time. And this works really well because they do have a high return on equity. So if you've got high retained earnings and a high return on equity, this leads to sustained high book value growth, which in turn leads to compounding. And on top of that, they have an excellent management team, which we will touch on later in this video. And as Warren Buffett says, banking is a very good business unless you do dumb things. And let's go to take a look at whether Hingham's does dumb things. So they talk about what they do and what they don't do. So what they do is commercial real estate lending, commercial and personal deposit banking, and residential real estate lending. And in comparison, what they don't do is these risky stuff, the dumb stuff, as Warren Buffett would say. The risky lending, the credit cards, the auto loans, the personal lines of credit, the investments. They don't do this. They stick to what they know, and they do what they do well. That's the main thing here. They don't do all this silly stuff that can get banks into trouble. They just do what works for them. And so far, over their history, it has turned out very well for Hingham's. So if we get into our first key metric here, it is the net interest margin. So what is the net interest margin? It's a measurement comparing the net interest income a financial firm generates from credit products like loans and mortgages with the outgoing interest it pays holders of savings accounts and certificates of deposits, or CDs. And how do you get the net interest margin? Well, you just get what the company makes in net interest income, and then you minus that with the amount it pays to saving accounts and holders of CDs. Then you divide it by the average earning assets. So this is the amount of assets the bank has on average over a certain period of time. And what makes a good net interest margin? Well, some would think that the higher the net interest margin, the better. But what really matters is the quality of the loans. And this changes from bank to bank. So let's say you have a bank that makes really risky loans but has a high net interest margin. It might not be better than a bank that takes less risk but has a lower net interest margin. So here we've got Hingham's compared to Bank OZK, JP Morgan, and Commonwealth Bank of Australia. We've got the 10-year median net interest margin, and for Hingham's it's 3.2. For Bank OZK, it's 4.6. For JP Morgan, it's 2.6. For Commonwealth Bank, it's 2.1. And what really matters here is the type of loans they make. So Hingham's, they make very low risk loans such as commercial real estate lending and residential real estate lending. Bank OZK, well, look, they've got a higher net interest margin of 4.6% over the last 10 years. However, if you look into their business, they make more risky loans. They make loans such as construction loans, which Hingham's simply just doesn't do, or they don't do it to the same extent that Bank OZK does. And then you've got JP Morgan and you've got Commonwealth Bank, and they do just about everything, and you can see that they've got a lower net interest margin. So if we move on to the net charge-off ratio, this really follows on from the net interest margin. This gives us a bit more context. So the net charge-off rate measures the proportion of debt owed to a company that is unlikely to be paid back to that company. So how do you get that? You simply get your net charge-offs and you divide it by the total amount of loans. So a net charge-off is just the amount of money that is not expected to be paid back. And if we do the same measure, so if we go back to 1997 and we get all the data up to 2021, you can see the amount of net charge-offs Hingham's has had over this time compared to the industry and what net charge-off ratio they have had over time. And there's multiple years, there's plenty of years, more years than not, where Hingham's has had net charge-offs of zero. So that means all the loans that they've lent out during that year was paid back. And they substantially outperform the industry when it comes to net charge-offs and net charge-off ratio. Even during the great financial crisis over 2008 through to 2010, you can see there was a huge spike in net charge-off ratio in the industry, whereas Hingham's had very minimal increases in their net charge-off ratio. And this is a case of them just taking very low risk loans that have very low likelihood of being or resulting in a net charge-off. And they've been consistent at this for multiple decades. So if we now jump and have a look at the key metrics so another key metric is deposits and funding sources. So the cheapest funding source is always or almost always long-term deposits, for example, bank accounts or CDs. However, not always can banks get enough funding from bank accounts and CDs to cover their loans. So as a result, we look at what's called a loan to deposit ratio. And if this is above 100%, it means that the bank needs to access other funding sources in order to meet that deficit there. So if we have a look at the loan to deposits ratio for Hingham's, this is probably a weaker point of their business, where they are over the last, all the way back to 2005, they've been above 100% every year, and it looks like their average is around about 120%, and at the moment they're actually at 126%. So what does this mean? It means they have to get funding sources from more expensive sources of funding. So funding that isn't long-term deposits here. And it's really important that we look into how they get this extra funding and how much it's going to cost them. So that's what I did. I went into their 10K and I had a look how they found this extra funding, and they get it from something called Federal Home Loan Bank Advances. And you can see that the amount here matches the deficit in order to get them to roughly 100% there. And Now we're going to think about how much is this costing him? Is this a problem? So I've come to the conclusion that it is not really a problem, because you can see the interest that they're paying on these federal home loan bank advances it was less than 1%. It's 0.28% in 2022, and then in 2023, it's 0.29% for these advances. So it's not going to kill him. This is very low interest debt, so it's fine. No worries here. But it is something to keep a look on, because if this over time starts to creep higher as interest rates increase, well, it's something to just keep in mind. Now, the next key metric is the efficiency ratio. So the efficiency ratio measures the proportion of net interest income that is spent on operating expenses. So pretty much the lower the efficiency ratio, the more profitable the bank is. And I've gone back to 2005 and I've graphed out the efficiency ratio that Hingham's has had over the last almost 17 years and the industry average. And the industry average is about 60% plus or minus 5%. So some years the average is about 55, and then on less profitable years the average is about 65. And you can see over time Hingham's has become more and more efficient, which means compared to their operating expenses, their net income has become a larger portion, and pretty much where they're at now is one of the best in the industry. It probably actually is the best in the industry. It is quite insane that they're able to do this and keep costs so low. So another key metric is leverage, and I've taken the same 4 banks from earlier in the video, and we've compared their different 10-year median assets to equity ratio. So this essentially tells us how much leverage is in the bank. And Hingham's has a fairly high amount of leverage in the bank. They've got a ratio of 12.4. Bank OZK has about half that, and it's got a ratio of 6.5. JP Morgan 10.7. Commonwealth Bank of Australia 15.4. And we can see over time Hingham has been deleveraging their business. Back 10 years ago, they had a leverage or a assets to equity ratio of about 14, and over time it's now drops below 10, and it looks like the trend is clearly down. So essentially, the more leverage, the more risk. However, this isn't always the case. It depends on how risky your loans are. So if you have loans of less risk, it means you can be more leveraged, as you're more likely to get paid back. However, if you're taking more risky loans, such as Bank OZK, you want lower leverage, because if these loans don't get paid back, well, then you're not in as much trouble. So higher leverage is okay if loans are less risky, and this means having low net charge-offs. So if we quickly sneak back to our net charge-off slide, which is here, you can see that Hingham's has very small net charge-offs compared to the industry. So they're making much less riskier loans, so they can afford to be more leveraged. So if we move forward here, and if we look at the management team, so the CEO is Robert Gorgon. Probably messed that name up, but it is what it is. We can see on this image here the directors of the company, and this really struck me. So I was going through their last annual report, and look how long these people have been at this company for, how long they've been directors of the company for. So we've got Brian here, he's been around since 2011. We've got someone else here, 1992, 1993, 1991, 2012, 2010, 1993, 2008, 2015, and 1997. We've got directors here that have been around for multiple decades. So these guys have got tons of experience. They're obviously good at what they do, or else they still wouldn't be here. And they're obviously very passionate. Go find me another management team that has directors, this many directors around, multiple decades. And even the person newest as a director, 2015, that's 7 years ago. She's been there 7 years, and she's the newest director of the company. So I think that says a lot about the company and their mindset. They're very long-term focused, and that is great for shareholders. So if we look at insider ownership, directors and executives, they own 31.22% of all the shares at the company. And if we look at the CEO himself, Robert, it looks like they've got looks like the family here, the Robert, Patrick, and Cara, they all own the same shares. So together they own 15% of the company. This is very high as an ownership of the company. Yes, I get it, it's a small cap, but this is what we want to see. They've got high stakes in the game here. So, if the stock doesn't do well, they won't do well. We won't do well. But if the stock does do well, I don't own this yet, but let's say I was to buy it, if I'll do well, if these guys do well, it works in both our interests. So if we move on to the next slide here, on this slide, we can see we've got a table here showing the compensation package of each of the directors at the company. And I've highlighted out the CEO here. So he makes $2 million a year. And what I want to do is I want to compare his annual salary compared to the amount of shares he owns, because we want to see that he owns plenty more shares than his annual salary. We want to make sure that his shares are way more important than what he owns as his salary. So if you remember before, the CEO has shared ownership of 341,802 shares between 3 people. So let's assume it's a 1/3 split and he owns 114,000 shares. So if we take that number and we times it by the share price of a couple of days ago, which it was about $275 per share, it's a little bit higher now, but let's just say he owns approximately $33.1 million in Hingham stock. So if we take his annual salary and we divide it by the amount of stock he owns, it gives us a ratio of 16. So this means the CEO owns 16 times his annual salary in Hingham stock, which is exactly what we want to see. Because what this means is that the share price going up or down affects him way more than his salary. And that's perfect for shareholders, because if he does well financially, we will also do well with our position. Another key aspect of this business is the payout ratio, and Hingham's has a very low payout ratio compared to other members of the industry, and this means they retain a lot of their earnings. And this is a problem if the company has low return on assets and low return on equity. However, in the case of Hingham's, they have the opposite. They have very high returns on equity. And you can see over time, this payout ratio has decreased. And what this has allowed Hingham's to do is reinvest back into their business to grow it. Instead of giving us dividends and doing share buybacks, they're fueling growth into the company by taking those earnings and investing it back into their own business. And they're doing it very effectively. And just how effectively? Well, let's have a look. So the first metric here is the return on assets, and I've compared the 10-year median return on assets compared to some other banks. So again, it's the same for banks. Hingham's has a return on assets of 1.3%, Bank OZK 2%, JP Morgan 1%, and Commonwealth Bank of Australia 1%. And if we look at how Hingham's return on assets has performed over time, you can see that there's been a clear uptrend on the return on assets of this business that has gotten better over time. However, I think return on assets isn't quite as good as a metric as return on equity, as businesses such as OZK, they tend to have higher return on assets because they take riskier loans. However, when we go and have a look at return on equity, you're going to notice that Bank OZK actually underperforms Hingham's because they don't have as much leverage. So really a better measure of just how well the business is compounding is their return on equity. And this paints a better story. So if we compare each of the banks, so we've got the 10-year median return on equity. We've got Hingham's here. They got a return on equity of 15.5%, Bank OZK 13.1%, JP Morgan 10.5%, and Commonwealth Bank of Australia 16.1%. And you can see over time, Hingham's has improved their return on equity quite considerably, where this year they're over 20%, and they've got a long track record of delivering high return on equity. Pretty much, even in the financial crisis back in 07, 08, 09, 2010, that sort of time, they still nearly delivered double-digit return on equity, which is quite spectacular. So moving forward, because of this long track record of just excellent return on equity, I think it would be fair to think that long-term, moving out over the next 10 years, their return on equity should stay between 10 and 20%. So now let's get into valuation. So what return is the current share price offering? So I want to quickly shout out Investing with Tom. He gave his audience a great little calculator on how to value banks. And I've filled this out with my own inputs here. So I've put a normalized return on assets of 1.5%. Their 10-year median is about 1.3%, and recent years they've been getting closer to 2%. However, I want to be conservative here, and while it has been on an uptrend, for this video, I'm going to put a 1.5% normalized return on assets. A normalized assets to equity ratio. They have been in a downtrend. If you remember back to that graph we looked at, they were about 10% this year. And then previous years have been up around 14%. They've slowly decreased to 10%. So I'm going to say over time that they'll end up falling in around the 8.5 range for assets to equity. Payout ratio, I think it's going to be about 9% moving forward. If you think back to the graph, we looked at the payout ratio, how it's been trending down over time, but I think 9% is fairly reasonable, especially since the company retains a lot of their earnings and reinvests it back into their own business. And then obviously we've got to enter the current price to book, and the current price to book is 1.37, and then we've put in a future price to book, and I've entered 1.89. And how I got this was I just took the mean over the last 10 years for the price to book ratio. In fact, I think this might be a bit conservative. You could easily put something like 2 in here, as the company is a fair bit better in terms of operating performance compared to early in the 2010s here. The company is a better company now, so you could argue that it should demand a higher price to book ratio. However, I've just put in the 10-year median here and the years of multiple expansion. So this is how long the price to book will take to catch up to our future price to book. I'll put in 5 years, and pretty much what this gives us is book value growth of 11.6% per year, multiple expansion of 1.8% per year, a dividend of 0.7% per year, and a total return of 14.1% per year. So essentially the current share price of $295.38 is offering us a 14.1% return. Now, what price do I want to pay? So I've pretty much done the same analysis here. However, I've made the price to book that I want to pay, instead of the current price to book of 1.73, I've made it pretty much 1.3. And the reason for this is that gets me to a 20% return. That's the return I want in order to own this business, and pretty much my buy price would then be $223.70, as that offers me an adequate return that I'm looking for. And pretty much, to summarize, this is a great business. The fundamentals look extremely strong here. Great management team. It's just that it's a little bit expensive. If you're after a 14% return, well, you could argue that you could get it at today's share price. However, I want a margin of safety here. I want to get that, expected return of, in the 20% range. So I might never get the opportunity to buy at $223.70. However, if it comes along, I'll be willing and ready to take my opportunity. And one of the reasons why we like to use price to book as well for these valuations is that banks tend to be quite choppy with their earnings, so they tend to be cyclical. So using a traditional discount free cash flow model does not work very well with banks, and because of that, you're much better off using a price to book ratio for these types of businesses. If it was just steady flowing, then yeah, great. You use the discount cash flow. However, it's just not like that in the banking industry. Therefore, we use price to book, and we come up with a model like we have here. So guys, that wraps up this video. Make sure you like this video and subscribe to my channel. I've been going really deep into companies, putting in a lot of work, so be on the lookout for more research coming out in the future, and have a great one.